Welcome to episode 22 of our series. Today, we are discussing backtesting, the process of testing before you invest. If you're new to the markets, this is the most critical lesson you will ever learn. Most beginners dive straight into the market with their hard-earned capital, hoping for the best. That is a recipe for disaster. The golden rule of professional trading is that your very first trade should always be conducted on paper, not with real money. You need to verify that your strategy actually holds water before you put a single dollar at risk. We are going to show you how to build a rigorous testing framework so you can avoid the common pitfalls that trap almost every retail investor in their first year. Let's open with a reality check. In 2021, a strategy published on Seeking Alpha claimed a backtested return of plus 47% annually. However, when traders applied that same strategy in live markets, it produced a return of minus 12%. That is a massive discrepancy. The truth is that most retail backtests overstate live performance by 30 to 60%. This gap is not accidental. It is structural. It stems from 5 predictable flaws in how people build their models. In this episode, we are going to map out exactly what those 5 flaws are and, more importantly, teach you how to close that gap so your simulations actually reflect the reality of the market. So, what does backtesting actually mean? Simply put, it is the process of replaying historical market data through a specific set of rules to see how a strategy would have performed. It is vital to clarify what backtesting is not. It is not a guarantee of future results, and it is certainly not just curve-fitting your parameters until a chart looks pretty. The true purpose is to filter out bad ideas before your capital is at risk. While we focus here on equities on the NYSE and NASDAQ, please understand that these principles are universal. They apply to any traded instrument you might encounter, from commodities to foreign exchange. To understand why we test, look at the research from Professor Hendrik Bessembinder. He analyzed all 26,000 stocks in the CRSP database from 1926 to 2016. His findings were sobering. Roughly 57% of individual stocks failed to outperform treasury bills over their lifetime. In fact, the median long-term return was negative, and the most common outcome for a single stock was a total loss of 100%. Only the top 4% of all stocks created all the net wealth in the entire U.S. market. This is why backtesting on a handful of current winners is so dangerous. You are essentially ignoring the graveyard of stocks that never made it. This brings us to the most dangerous flaw in backtesting: survivorship bias. Most databases only contain stocks that exist today, while companies that went bankrupt or were delisted simply vanish from the record. If you test on today's S&P 500 constituents, you are giving yourself perfect foresight. Think of the famous World War II example involving Abraham Wald. Military analysts wanted to reinforce the areas where returning planes had bullet holes. Wald argued the opposite: reinforce the areas without holes, because the planes hit there never came back. Backtesting on only surviving companies is like looking at the planes that made it home and ignoring the ones that were shot down. Let's look at the numbers. Michael Harris conducted a study in 2019 testing a trend-following strategy on the S&P 100 from the year 2000 to 2019. The rule was simple: buy at the next month's open if the monthly close is above the 12-month moving average, and sell if it drops below. When he used a survivorship-biased dataset, the strategy returned 8.4% annually. But when he included delisted stocks, the return dropped to 6.5%. That is a 2 percentage point gap on a very simple strategy. As you move toward more complex approaches, that gap widens dramatically, proving that your data quality is everything. The impact is even clearer in Harris's study of the NASDAQ 100 between 1993 and 2020. The strategy bought the 10 stocks with the highest 6-month rate of change, rebalancing monthly. On a survivorship-biased dataset, the compound annual growth rate was a staggering 46% with a max drawdown of only 41%. However, when he included the companies that were delisted, the growth rate collapsed to 16.4%, and the max drawdown spiked to 83%. That represents the dot-com wipeout, where companies vanished entirely. The difference between a hero strategy and a total disaster was purely in the dataset used. Next, we must address look-ahead bias, which is essentially trading with tomorrow's newspaper. This happens when you use information that was not available at the time of your trade. A classic example is selecting stocks based on quarterly earnings per share growth and rebalancing on March 31st. The problem? Most companies do not report those results until April or May. If your backtest uses March earnings on March 31st, you are peeking into the future. Other sources of this bias include using adjusted closing prices that account for splits and dividends before they were actually announced. You must use point-in-time data to ensure you only use information that was publicly available on that specific day. Then there is overfitting, which is what happens when your strategy memorizes the past rather than learning a pattern. Think of it as tuning your rules so perfectly to historical noise that they stop working the moment the market changes. A good rule of thumb is this: if you have more than 3 or 4 optimized parameters and fewer than 100 trades per parameter, you are almost certainly overfitting. Warning signs include win rates above 85%, equity curves that look suspiciously smooth, and performance that falls off a cliff when you test it on new data. The market never repeats its exact path, and a strategy tuned to past noise has no edge. To stay honest, you must split your data into in-sample and out-of-sample segments. You use the in-sample data to develop and optimize your strategy, and you reserve the out-of-sample data purely for validation. A common practice is to hold back 30% of your data for this final test. If your strategy shines in sample but fails out of sample, it was likely curve-fitted to the noise. Your out-of-sample period must include different market regimes, at least one bull phase, one bear phase, and one sideways period. Testing only on a long bull run like 2010 to 2021 tells you nothing about how you will handle a 2022-style drawdown. The gold standard for validation is walk-forward analysis. Instead of one static test, you use a rolling window approach. You optimize on a training window, test on the next forward window, and then shift both windows ahead. This mimics how a real trader operates, re-optimizing periodically with only the data available at that time. This produces a distribution of results across many different market environments. The key metric here is the walk-forward efficiency ratio, which is your out-of-sample performance divided by your in-sample performance. A ratio above 70% suggests your strategy is robust and likely not overfitted, giving you much higher confidence in its future potential. Now, let's talk about the silent killer, transaction costs. Many backtests ignore these entirely, but they are a constant drain on your account. Even if your broker offers zero commissions on equities, regulatory fees still exist. If you trade options, you might pay 65 cents per contract. For active strategies, the cumulative drag is massive. If you make 200 round trips per year at just 0.1% cost per trip, you're losing 20% of your gains annually to friction. Before you trust any backtest, stress test it by gradually increasing your cost assumptions from 0.25% up to 1.5% to see where your break-even point lies. Closely related to costs is slippage, which is the difference between your expected price and your actual fill price. For liquid stocks like Apple or Microsoft, slippage is usually quite low, around 0.01 to 0.05%. However, for mid-caps, it can reach 0.5%. There is also time drift slippage, which hits end-of-day traders. Your signal might fire at the close, but you do not get filled until the next morning's open. In volatile markets, that overnight gap can be huge. If your strategy averages a 2% profit per trade, a 0.5% round-trip slippage consumes 25% of your profit before commissions. To see if your results are luck or skill, use a Monte Carlo simulation. Take your actual trade results from your backtest and randomly reshuffle their order thousands of times to see what other equity curves could have been generated. If your original result falls in the top 5% of those simulations, you might have a genuine edge. If it lands in the middle, your historical success was likely just a lucky sequence of trades. This answers the vital question: would this strategy still look good if the good trades and the bad trades had arrived in a completely different order? It is the ultimate test of your strategy's stability. When evaluating your results, focus on the Sharpe ratio and maximum drawdown. The Sharpe ratio measures your risk-adjusted return, essentially your average excess return divided by its standard deviation. A ratio above 1 is acceptable, while above 2 is strong. Maximum drawdown measures the biggest peak-to-trough decline. Remember, a 40% drawdown requires a 67% gain just to get back to break-even. These two metrics tell the real story. A strategy returning 30% annually with a Sharpe of 0.8 and a 50% drawdown is significantly riskier than one returning 15% with a Sharpe of 1.5 and only a 12% drawdown. Never underestimate the importance of sample size and statistical significance. A backtest over 10 years that only includes 12 trades is statistically meaningless. You generally need at least 30 to 50 trades to start drawing conclusions, and 100 or more for real confidence. For every parameter you optimize, aim for at least 100 trades to ensure your results aren't just a fluke. A strategy tested on only 50 trades might show a great win rate, but the confidence interval is so wide that your true edge could actually be negative. While intraday strategies can be validated faster due to more trades, they also face much higher transaction cost drag. If you're looking for a platform, TradingView is the most accessible tool for retail investors. Its built-in PineScript language lets you code strategies directly on your charts. It offers decades of data from major U.S. indices and includes performance reports showing net profit, Sharpe ratio, and drawdowns. However, it has limitations. You cannot upload custom data, its slippage modeling is basic, and it lacks automatic survivorship bias-free datasets. At around $168 annually for the essential plan, it is best for beginners who want to test simple indicator-based strategies on recent historical data before moving to more advanced environments. For those ready to level up, Python and the Backtrader framework are the industry standard. It is free, runs locally, and supports custom data feeds, including survivorship bias-free data from providers like Norgate Data. It features an event-driven architecture and deep analysis tools for Sharpe ratios and drawdowns. It even integrates with interactive brokers for live trading. The learning curve is much steeper than TradingView because you need to know Python. While the framework is no longer actively maintained, it remains a stable and powerful choice for intermediate to advanced users who require total control over their data quality and complex cost modeling. If you prefer a cloud-based solution, look at QuantConnect. It supports both Python and C# and offers institutional-grade data, including delisted stocks. It provides advanced cost modeling where you can customize slippage and commissions, and it runs your backtests on their servers, so you don't need powerful local hardware. With a community of over 370,000 quants, it is a powerhouse for serious development. There is a free tier for testing, and paid plans scale with your usage. It is the best choice if you want high-quality, bias-free data and realistic execution modeling without the burden of maintaining your own local data infrastructure. Let's summarize with a 5-point validation checklist. First, use a dataset that is free of survivorship bias by including delisted stocks. Second, ensure your data is point in time. Never use earnings or split information before it was publicly announced. Third, optimize only on in-sample data and then validate on at least 30% out-of-sample data using walk-forward analysis. Fourth, model realistic costs, including commissions, slippage, and overnight gaps, and stress test your strategy up to 1.5% in total costs. Fifth, ensure you have at least 100 trades per optimized parameter and confirm that your walk-forward efficiency ratio exceeds 70%. If you pass these, you're ready for paper trading. The core mindset shift today is realizing that backtesting is not about proving your strategy works. It is about trying to break it. You want to find every possible reason your strategy might fail before you risk a single dollar of your capital. As the Bessembinder data proves, most individual stocks lose money, and survivorship bias is designed to hide that. A strategy that survives realistic cost modeling, out-of-sample validation, and Monte Carlo stress testing has earned the right to be forward tested. Remember, forward testing means paper trading, not live trading. The gap between your simulation and your live results is predictable, but only if you account for these realities up front. That brings us to the end of our deep dive into backtesting. In our next episode, we move from statistical validation to the geometry of price action. We will cover Fibonacci, Elliott wave, and key levels to answer the question, where might the market bounce? We will explore retracements, extensions, and the various wave patterns that technical analysts have relied on for decades to identify potential turning points in the market. It is going to be a fascinating shift from the numbers we discussed today to the visual art of reading price charts. I will see you in episode 23.